Hello everyone, welcome to Finance Wisdom. In this video, we're going to talk about S&P 500 Index Fund Explained Beginner's Guide. If you're new to this channel, do like and subscribe to the channel. You're an ordinary American and you're thinking to yourself, I know I should be saving for my retirement, but I don't know how to do it. I've heard that placing your money in the stock market would result in higher long-term growth and investment than putting it under your mattress, in a CD or in a secure investment. Then, one day, a light bulb went off in your head and you thought that maybe I should be investing in S&P 500 index funds. It probably didn't happen that way, but the point is that now you know you've heard of the S&P 500 and you believe you know what it is and how it will benefit your portfolio, but you don't actually know how much more about the S&P 500. I'll show you all you need to know about the S&P 500 index in this video. Everything an ordinary American investor needs to know about investing in an index fund as an exchange-traded fund. I'm going to reveal 4 interesting unknown facts about S&P 500 index funds to you that most people, particularly the typical American, are unaware of. You won't be able to claim you're an ordinary American at the conclusion of the movie since you'll know so much about the S&P 500. We're talking about the S&P 500 Index Fund, and although most people are familiar with the fundamentals, I'd like to provide you with a wealth of additional knowledge, absolutely everything you need to know. Alright, let's get started talking about the S&P 500 and S&P 500 Index Funds. The first unknown fact. Things you didn't know about the S&P 500 right away, I'm going to reveal one of the S&P 500's little-known truths to you. The majority of people believe that the S&P 500 index represents 500 firms. Yes, but it really refers to 505 distinct stocks. This is because, although the S&P 500 comprises 500 separate firms, a few of them have several shares of stock, such as Class A, Class B, and Class C, resulting in the S&P 500's having 505 different stocks. The S&P 500 index includes 500 of the largest companies in the United States, but not necessarily the top 500. It is determined by a variety of factors, including the company's profitability, volume of trading, and market capitalization. In other words, how much the firm is worth, as well as a variety of other characteristics that you, the typical American, are uninterested in. So you're thinking to yourself, I know there's something called the S&P 500 index, but how can I invest in it? How does it work? You may wonder. You must make a contribution to the SP 500 index fund, which then acquires shares in all 500 firms that make up the SP 500. When investing in the S&P 500 index, one of the most important things to remember is that you will not be able to outperform the market. You're following the market, which isn't necessarily a terrible thing since the market has performed well over the last 5, 10, 15, 20, 50 years. Even though there will be bumps along the way, up and down, it will all work out in the end. The second unknown fact. We have arrived at the second important truth about the S&P 500 index, which most people are unaware of. By definition, all S&P 500 index funds are market cap weighted index funds. Despite the fact that there are 500 firms and 505 distinct stocks, they are not all created equal, which means that not all 505 stocks are held equally. Some of the world's top corporations such as Apple, Microsoft, Amazon, Facebook, Google, Tesla, Berkshire Hathaway, Johnson & Johnson, and JP Morgan Chase are represented by the typical dual investor. Despite the fact that there are 505 distinct stocks in the index, these companies possess between 1% and 6% of it. On the other hand, some of the tiniest businesses control up to 6% of the market. You could be thinking about Unigroup Xerox Holdings in the S&P 500's Armor Classes A, C, or News Corporation Class B. Only about 0.01% of the index is held by these firms. You are diversified if you hold the S&P 500 index, but not as much as you may assume. In fact, across all kinds of mutual funds and index funds, the top 10 holdings in the S&P 500 index are quite similar. You may own around 28.2% of the fund's assets, while the top 10 stocks account for more than a quarter of the total. You're a typical American who wants to put money into the S&P 500 index. You may invest in the S&P 500 index in 3 distinct ways. The first option is to invest in a mutual fund, sometimes known as indexed mutual fund or index fund. The second option is to invest in an exchange-traded fund or ETF, and the third option is to invest in a unit investment trust. For now, think about the difference between mutual funds, exchange-traded funds, and unit-invested trusts. You may acquire mutual fund shares at any time throughout the day, but the price you receive at the end of the day is determined by the investing company's ability to reconcile all the purchases and sales. So whether you purchase at 9 o'clock in the morning, 10 o'clock in the morning, or any other time, you'll receive the price at the end of the day. On the other hand, ETFs and unit investment trusts, on the other hand, trade similarly to stocks in that if a stock is selling at $90 or $120 at 9 o'clock in the morning, and that's the price you want, you may purchase it at that price. The 3 biggest participants in the S&P 500 ETF field are the Vanguard S&P 500 ETF ticker symbol VO, the iShares Core S&P 500 ETF ticker code IVV, and the SPDR S&P 500 ETF Trust ticker symbol SPDY. If you like this video, don't forget to like and subscribe to the channel. The SPDR S&P 500 SPY is a unit investment trust that replicates the S&P 500 index rather than an exchange-traded fund. You may be wondering, what does it mean? It's both minor and important at the same time. Please accept my apologies for being a little ambiguous. A unit investment trust is organized similarly to an exchange-traded fund or ETF, although it is more passive. It can't be an actively managed fund according to the regulations. Actively managed exchange-traded funds or ETFs exist. They aren't all that common. Their rules make them mainly indexed and passive. The unit investment trust must be passive and based on a set portfolio. It cannot be actively traded. Furthermore, unit investment trusts have a defined end, implying that by the year 2118, we will most likely have flying automobiles as well as small tablets that we can pop in the microwave and turn into a whole meal. The unit investment trust known as SPY, on the other hand, is set to be dissolved and liquidated in the year 2118. I'm presuming there's a method to expand it, which isn't anything special. Another important thing to understand about unit investment trusts is how they manage in dividends. Many S&P 500 companies pay dividends to their shareholders, and if the shareholder is an investment firm, the dividend may be taken and reinvested immediately before being paid out on a quarterly basis at a later date. Because corporations pay dividends on a variable timetable throughout the year, the dividends may be promptly reinvested by the investment company and then paid on a quarterly basis, possibly reaping the biggest benefits. The rules of a unit investment trust, on the other hand, restrict dividend reinvestment immediately. You must pay it in cash and keep it in cash until that time. It's possible that this will result in less favorable outcomes. The reverse is also true, though. If the unit investment trust keeps that money and we enter a bear market, that money may be worth more than it would be if it were immediately reinvested. In the end, it resulted in relatively similar results for the 3 enterprises. Expense ratios are included in all 3 S&P 500 ETFs. The management company's fee for managing this investment on your behalf is quite modest. The SPDR S&P 500 Unit Trust has an expense ratio of 0.0945%, which means that $10,000 invested in this product will cost $9.45. It also has by far the highest trading volume, and many investors use this technique to hold S&P 500 options due to the volume. It's also the oldest S&P 500 ETF, having been created in 1993. The iShares Core S&P 500 ETF is ranked second on this list with the ticker code IVV. IVV has a cost-to-income ratio. Although IBV has less trading volume than SP, it has a lower expense ratio and larger trading volume than the third ETF we'll discuss. The third index fund is the Vanguard S&P 500 ETF or VO, which has the lowest cost ratio of 0% or $3 for every $10,000 invested, as well as the lowest trading volume among the three index funds. The ordinary American investor, on the other hand, is unconcerned about it since these assets should be kept for the long term. The fourth unknown fact. Regarding the S&P 500 index, I've had a question for a long time, and I'm sure many other typical American investors have as well. You will see that three separate businesses, IVV, S&P, and VO, all have different pricing for the S&P 500. Why? If they all allow the same index, do they all have different prices? You may wonder. It is unethical for me to buy shares of an ETF that is cheaper than another. Is it possible that I'm being tricked in some way? Is there a difference in the amount of value I get for my money depending on which one I own? The fact is that there isn't much of a difference. Although there are pricing variations, a $100 investment in any of these ETFs will provide the same results since they all follow the S&P 500. The real performance of the 500 biggest firms is now IVV is priced at $370.31 per share. VO is marketed at $339.16 per share and SPY is priced at $369.16 per share. But 100 invested in any of these three ETFs would provide the same outcome. The most important reason for the disparity in costs is that they did not all begin on the same day. The genesis dates of these three ETFs are all different. As a consequence, organizations with greater growth potential will have a higher share price. Keep in mind that the cost ratio is the most significant difference between these three S&P 500 ETFs. If you're dealing with huge sums of money, a VO or IVV is the way to go. However, if you're considering trading S&P 500 options as well, a VO may be more beneficial. This video should have provided you with some useful information. Please let me know if I answered your questions about the S&P 500 if you found it useful. If you learned something new, and if there are any other educational topics you'd like to learn about in relation to dividend investing in personal finance. Thank you for watching. I hope you have learned something from this video. If you like this video, do give us a like, subscribe to the channel, and comment down below. Thank you and goodbye.